Welcome back to the channel and welcome to episode 2 of the Road to 100K series. If you're new here, this series is a completely transparent step-by-step look at my actual investment journey. No fake lifestyle, no hidden numbers, and no crazy editing. Just raw data of an ordinary guy grinding his way towards a six-figure net worth. In episode 1, we set the baseline. Today, we're checking in on the progress, tracking the changes, and talking about how to navigate a market that feels increasingly disconnected from reality. Let's jump right into the numbers. First up, let's look at the raw data for where my portfolio stands today. Right now, the total capital invested across my accounts is exactly $58,696.49. If we split that up into the two primary buckets I use to build wealth, my brokerage account makes up the larger piece, sitting at $38,264, and my 401k is crossing another major psychological boundary, currently at $20,431. Hitting over $58,000 feels incredible. When you're in the day-to-day grind of working, paying bills, and investing whatever's left over, progress can feel slow. But when you step back and see a number like nearly $59,000 staring at you, it reminds you that the discipline is paying off. We are officially knocking on the door of the $60,000 milestone. But numbers don't mean much without context. So let's look at how much progress we actually made since episode 1. If we look at the changes between the last update and this one, the brokerage account went from $36,000 to $38,000, an increase of roughly $1,700. The 401k went from $18,644 up to $20,431, which is an increase of $1,787. Overall, the total portfolio grew from $55,132 to $58,696. This means we added $3,564 to our total net worth since the last video. Seeing both accounts move off almost completely in tandem by nearly $1,800 each is awesome. A chunk of this is market movement, but a massive part of it is just raw forcing of capital into the market, which takes us into the next slide. This is the unsexy part of personal finance that a lot of people gloss over: the actual savings rate. Wealth building isn't just about picking green stocks, it's about how much money you can consistently shovel into the engine. For this update, I was able to contribute $394 into the 401k and $640 directly into the brokerage account. So shoveling over $1,000 into the market in a single cycle takes sacrifice. But this is the foundation of the road to 100k. Every single dollar I put right now is a worker assigned to go out and make more money for me in the future. It's about buying back my time piece by piece. Now let's open the hood and see what's actually inside these accounts. We'll start with the 401k. Here are the top 5 holdings driving the account right now: Nvidia, Apple, Google, Microsoft, and Amazon. As you can see, the 401k is heavily weighted towards big tech, which are the top holdings of the S&P 500. In a traditional retirement account, you're often tied to the broader markets index fund. And right now, the major market capitalization means these 5 giants are carrying the team. It's given me great exposure to the massive run-up we've seen recently, acting as an aggressive growth engine of my wealth journey. Next, let's shift over to my individual brokerage account. This is where I have total control over my stock selection, and my strategy here tilts more towards individual high-quality dividend growth names. Here are my top 5: Google, S&P Global, Hershey's, Automatic Data Processing, and Texas Instruments. Outside of Google, which I'm incredibly high on, look at the rest of that list. You have financial infrastructure with S&P Global, consumer staples with Hershey's, and massive cash flow compounders like ADP and Texas Instruments. These are boring, reliable cash engine businesses. They aren't flashy, but they are built to survive any economic environment and consistently hand cash back to the shareholders. Speaking of handing cash back to the shareholders, let's talk about the real reason I love dividend growth investing: the passive income snowball. I want to show you exactly what consistency looks like over a multi-year timeline, because this is where the math becomes beautiful. Look at my annual dividend payout since I started. In 2020, I made a grand total of $23.67. A lot of people will look at that and quit thinking it's not worth the effort. In 2021, it grew to $90.55. 2022, we broke triple digits at $208. In 2023, the snowball started heavy rolling to $396. In 2024, we hit $537. And last year in 2025, we finished at $570.03. Now look at where we at for 2026 year to date. We are already sitting at $313.56. We are only halfway through the year, and I have already brought in more than half of what I made in all of 2025. This is the power of the dividend snowball. I take every single check these companies send me and I instantly reinvest it to buy more shares, which ensures the next check is even bigger. It's a self-sustaining wealth machine. But it's not all sunshines and rainbows. Part of keeping this channel completely honest means showing the areas where I'm falling behind. Let's look at my year-to-date performance compared to the major market benchmarks. Year-to-date, my 401k is up 6% and my brokerage account is up 2%. 2.89%. Now, look at the indices. The S&P 500 is up 7%, Dow Jones is up 5%, and the Nasdaq is completely running away from the field at 12%. If you look closely, my brokerage account is significantly underperforming the broader market right now. It's trailing the S&P 500 by a wide margin and getting absolutely dusted by the Nasdaq. The reason my brokerage account is lagging behind is simple. We're living in an entirely AI-driven market right now. The Nasdaq is flying on a pure tech hype, and to be completely blunt with you guys, I strongly believe we are in a massive market bubble. Right now, Wall Street is piling capital into anything associated with artificial intelligence, while high-quality, reliable dividend and value names are completely ignored and left flat. But here's the thing, I am not going to alter my core philosophy to chase the hot trend. My strategy remains the same. I am going to keep dollar cost averaging into my highest conviction stocks that are currently down or flat. When the market ignores quality because it's distracted by shiny objects, that is exactly when I want to buy. I want to buy the companies that are on sale, not the ones that are trading at all-time highs on pure emotion. That being said, I'm contemplating one major adjustment. I'm currently looking over my numbers and thinking about changing my contributions allocation moving forward to optimize my capital efficiency across both 401k and the brokerage account. I'm running the math right now, and I'll take you guys along for the ride once I finalize that plan. We're sitting at over $58,000, the dividend engine is humming, and the road to $100,000 continues. I appreciate every single one of you tracking this journey with me. Drop a comment below and let me know, are you chasing tech right now, or are you buying the unloved value stocks? Smash that subscribe button if you want to continue following my journey. Thanks for watching, and I'll see you in the next one.